So welcome. We're going to be talking about the second part of this lecture series, banking regulations, where we talk all about banking regulations. Yay. So let's move on. We're going to be talking about, why bank regulations exist. We're going to talk a little bit about some of the terminology behind it. We're going to get into the Basel II Accord, covering the pillars of Basel II, and then also what Basel II is really meant to do. Like, why does it exist in the first place? What does it intend? What is the intended goal here? What's it trying to accomplish? And what types of risk is this really trying to mitigate? And then from Basel II, we're going to be moving into stress testing and CCAR, which for any of you that currently work in banking, or for anybody who intends to later work in banking, you will find this out in the future. CCAR will become the absolute bane of your existence if you work under the risk vertical, like, at all, ever. It comes around every February, middle of every February. So if you ever had plans for Valentine's Day and you work in risk, well, good luck with that, because you're going to end up having to deal with Fed scenarios that get released right before Valentine's Day. But then again, now that I think of it, a bunch of computational nerds. Oh, maybe it gives them an excuse to not have to do anything on Valentine's Day. Moving right along on that one. So let's talk about what capital requirements are. That seems like a pretty important thing we can discuss. So capital requirements. These are really centered around the amount of capital that banks have to have as set by financial regulators. And they're designed to make sure that banks remain solvent. So let's say that there is either an adverse or like a severely adverse scenario that the bank enters into. So let's say there's, a lot of defaults, right? A lot of people default as a result of the economy going into a recession and things getting really bad. Will the bank have enough capital? Will the bank have enough assets on hand in order to ensure that they can weather the storm, so to speak? Can they absorb the losses that they're going to face without becoming insolvent? Now, this is where I kind of need to specify that insolvency and illiquidity are not the same thing, because if you are illiquid, right, if you're a bank and you're illiquid, you've got a lot of assets on hand, but maybe not enough cash. So these assets will have positive value. So you can hold like a lot of mortgages, right? You can have a lot of treasuries. In that case, you've got items, these assets of positive value. They can be converted into cash, but they're not cash right now, and they may not be able to be converted into cash by the end of the business day. So in that sense, you are solvent, but you are not liquid. On the other hand, if you're insolvent, well, then you're like super screwed, because in this situation, you don't have sufficient assets in order to be able to pay any of your debt obligations. So an example would be like, let's say if you own a mansion and like 3 Lamborghinis, but you've only got like a couple of $1,000s on hand, well, you're not illiquid, or you are illiquid, right? But you've got assets of positive value. On the other hand, let's say you've only got a couple $1,000s in hand, and you don't have a house and 3 Lamborghinis. Well, in that case, you run the risk of becoming insolvent, because you're not going to have any additional assets of positive value that you can convert into cash in the event that you need to. So these capital requirements make sure that these banks have enough assets on hand so that they don't have too much debt, which is where we get into the concept of leverage. Now, leverage is the ratio of debt-financed acquisitions to the value of common stock, which is equity. Now, a lot of times, if you want to buy an asset, you're going to take out debt in order to be able to do it. And you're going to do this because you expect to be able to pay off the debt that you took out. So if, say, you want to buy a new building for office space, right? That's awesome. You buy this new building, you put office stuff in there, and you do so by borrowing money to do it. Now, you're only going to be borrowing money to expand your operations if you believe that the expansion in operations is also going to be bringing in additional revenue for your business. But let's say that you expand your operations and then the economy goes into a recession and you got to let a bunch of people go. Well, now you've got all this real estate that isn't really doing much for you. You're kind of screwed, because while you're going to have to start being able to make payments on the debt that you took out to finance this expansion in business operations, you no longer have revenue coming in that's sufficient to be able to pay that off. So uncertainty is everywhere, right? Because if you want to expand your operations and you got to borrow money to be able to do it, you need to be fairly certain that you're going to be able to pay it off. But there's always a chance that you're not going to be able to pay it off. So what leverage is telling us is it's giving us this ratio, it's a fraction, right, of these assets that were financed by debt relative to the equity that the company has, or like the value of the common stock. So naturally, you don't want this leverage, this ratio, to be too particularly high, because that means that you start getting into a territory where you've got more debt-financed asset acquisitions than you have equity. And that's not a particularly good thing. So what is the formula for leverage? Well, the formula is total debt over equity, and it's also what's known as a debt-to-equity ratio. And as I said in the previous slide, if you get into a situation where you've got more debt than equity, you start getting into some pretty big problems here, and that's something that naturally you will want to avoid. So let's get into capital adequacy ratios, because they're a little different from leverage ratios. Now, the capital adequacy ratio is the adequate amount, which is typically defined by a regulator, of capital that a bank has to hold as a percentage of its risk-weighted assets. So capital adequacy ratios will take the ratio of the risk-weighted assets to capital, whereas the leverage ratio is the ratio of debt to equity. So you can see these two things really aren't the same. But now that we've covered that, let's move on to a couple other things, and then we'll be moving on to the Basel II stuff. So let's talk about risk, because there are all sorts of different types of risk that banks will face. And depending on what kind of a bank you are, what size bank you are, things like that, it will really be determining what types of risk you're going to be facing, right? Because if you're like a small bank, like a small regional bank, foreign exchange risk probably isn't something that you're going to be having to deal with, right? But, let's say all banks are likely going to be facing some type of liquidity risk or interest rate risk, credit risk, things like that. So there are different types of risk that banks can face. Now, a lot of these, like I said, a lot of banks are going to face, like pretty much all banks, like reputation risk, right? If, say, one of your employees does something particularly stupid, then that puts you at reputation risk, because it's putting the reputation of the bank at risk with the public. Now, credit risk, that's something that we've talked about ad nauseum at this point, where it's really the risk of facing a default. And that's not something that, you want. So these 9 categories here are listed by the Office of the Comptroller of the Currency. Now, we can categorize market risk as any kind of risk that results from fluctuations in market variables. So this could be equity, interest rates, currency, commodities. Right? So really any kind of risk that can arise from just the way the market operates. Say, you go into a recession. Well, that can really start to mess with some things, right? That would be a form of market risk. Now, the interest rate risk here, that's something that we'll be talking about with Silicon Valley Bank next week. Particularly interesting stuff there. But again, we should probably talk about risk and risk management, risk mitigation, all that stuff before we really get into Silicon Valley Bank. But that is sort of the end goal here. Let's talk about operational risk. So operational risk is the most basic form. It's the risk that any business faces from day-to-day operations. So it can be policies or programs that disrupt operations. So, you could have like fraud, embezzlement, criminal activity, right? That's going to put you at operational risk, because let's say you embezzle a bunch of money from the bank. Well, the bank is screwed in that case, right? You make off with a bunch of money, and the bank, on the other hand, is like, wait a minute, where's all this cash that we had? Where's all this money, right? Any kind of bad activity like that, criminal activity, that essentially hurts the bank, that's operational risk. But that isn't all of operational risk, right? There are other things like physical events, natural disasters. So if you get hit by a tornado, right, that's operational risk. If a hurricane blows through, operational risk. Now, The other one that we got here is credit risk. And credit risk is what we talked about a lot in the last lecture, which is risk that a lender has or that a lender faces from the risk of default. So you lend money to somebody who then can't pay it back. Well, if you do that, you're on the hook, right? If you lend $500,000 to somebody so they can buy a house, and then all of a sudden they can't pay it back, you're on the hook, which is also why you have to, foreclose and take the house back and all that stuff, which we talked about a good bit last week. But with these, we got market risk, operational risk, and credit risk as like the main categories that we're going to be interested in. So getting into credit risk, what are the types of credit risk? Well, the credit default risk, that's the risk of loss from a debtor who is now unlikely to pay loan obligations, right? So let's say it goes like 90 days past due. That would be credit default risk. So if you lend money to somebody and they face any positive risk of not being able to pay it back, well, you are at credit default risk. There's concentration risk. What is concentration risk? Well, that is any risk associated with any single exposure or group of exposures with potential to make losses bad enough to threaten a bank's core operations. And what that really stems from, right, what this really is saying is that if you are not adequately diversified, right, so you're a bank and let's say that you have like your portfolio is very concentrated in like one area. Let's say, all of your assets are like home mortgages. And there's a huge like housing crisis. Well, you could be screwed. That's putting you at concentration risk. Essentially, you've got all of your eggs in one basket, and that's not something that you want to have, right? You want to be diversified so that if you get losses in one area, you can make up for those losses in other areas that are not going to be affected. Then there's country risk. Country risk is a really interesting one. It was like super interesting about a year ago when Russia was removed from the SWIFT banking system. And it's when a sovereign state would freeze foreign currency payments or if it defaults on any of its debt obligations, also known as sovereign risk. And for these types of credit risk, banks have to do a couple of things to be able to mitigate this. The first one would be like risk-based pricing, where they set interest rates based on how risky they think the borrower is going to be. So let's say if you want to take out a credit card, if you are a particularly risky borrower, then they're likely going to hit you with a higher interest rate. Or if you want to take out a loan, right? If you want to take out a personal loan to pay off some credit card debt that you've got, if your credit card or if your credit score is particularly low, right, that shows the lender that maybe you're not going to be the best suited to be able to repay the loan that you took out. So what are they going to do? Well, they see you as a potentially risky borrower, so they're going to hit you with a higher interest rate. And the idea on that would be they want to be able to recoup their losses as fast as possible. So if, let's say, you're going to go a year, they think you'll go a year before you default, well, they can either charge you a 1% interest rate or a 10% interest rate. Well, if they charge you a 10% interest rate and you default in a year, then they've earned back a little bit more money than they would have on, say, a 1% interest rate. So they essentially price based on the perceived risk of the borrower. And then we have stipulations on the borrower, such as reporting the financial condition periodically. So let's say that you lend money to a business and you're like, yo, I'm lending this money to you, but you are kind of a risky, this is kind of a risky loan that I'm making here. So what I want is if I'm going to give you this money and you're going to pay it back, I'm going to need to know what your financial conditions are, right? So let's say you'll have to report those to me quarterly in order to remain in good standing for the repayment of the loan. Now, there's tightening. What is tightening? Well, that is when you lower the line of credit for the borrower. So let's say you took out a credit card, you get a $10,000 credit limit, and you're making $15,000 a year. So within 2 weeks of that $10,000 credit limit, let's say you spend $8,000. All right, you are now $8,000 in debt. The credit card company goes, oh boy, this doesn't look particularly good. And then let's say you miss a payment or two. on that credit card, they're really going to start freaking out. So instead of allowing you to rack up an additional $2,000 of debt, which puts them even more in the hole, what they're going to do is they're going to lower that line of credit to make sure that basically you don't spend any more money than what you've already spent. And then there's also deposit insurance, which we'll be getting into when we talk about bank runs a little bit later. And what happens here is that bank deposits are going to be guaranteed by some other like insurance corporation or some insurance entity in the event that this bank becomes insolvent. I mean, there are all sorts of issues around deposit insurance regarding like moral hazard because, well, the bank can behave, a little bit more poorly if they know that their assets are going to be covered by somebody else. But that is another lecture for another time. So let's talk about Basel II just for a moment. These are recommendations on banking laws and regulations that were issued by the Basel Committee on Banking Supervision. It was originally published in June of 2004 as a new framework for international banking standards. These regulations were meant to ensure that banks have enough capital to essentially cover their asses if they become exposed to any sort of additional risk. And it was ultimately designed to try to safeguard solvency for banks. And they also wanted to be able to level the playing field across international banks. Now, there were 4 objectives for Basel II, and they were to ensure that capital allocation is risk sensitive, enhance disclosure requirements that allow market participants to assess capital adequacies, ensure credit risk, operational, and market risk are quantified based on data and formal techniques, and to align economic and regulatory capital to reduce regulatory arbitrage. And there are 3 pillars of the Basel II Accord. The first one is minimum capital requirements. So this is the requirement of regulatory capital for the 3 major components of risk that the bank will face, which is credit, operational, and market risk. And there are various computing methods used for these 3 types of risk, which we've actually talked about a little bit in the previous lecture with like probability default models, all that fun stuff. So basically, this is requiring that they have a minimum amount of capital, or they have to have a certain number of assets or amount of assets on hand in order to be able to weather the storm that could arise from changes in credit, operational, or market risk. And then they have to be able to have various computing methods to make sure that they are adequately modeling these types of risk. And then based on these adequate models for these forms of risk, they can then have forecasts that will suggest and provide additional evidence for any claims that they will, in fact, be able to weather the storm should the storm show up. And a lot of that behavior is basically entirely internal. There's a supervisory review process, right? This is where some of the external stuff kind of starts to come into play, because this is designed to give regulators better tools to be able to deal with various types of risks that the banking sector and financial institutions in general will face. This is like where, the stress testing stuff will come in. Regulators want to be able to make sure that they can assess these risks appropriately, and that essentially these banks are also reporting their risks and their balance sheets accordingly, right? They want to make sure that they're doing it appropriately and in such a way that, is accurate and will show that, well, we can get into market discipline, which is once the supervisory review process is done, right? Once the regulators have, applied enough oversight, we'll say, to what's been going on with how the banks are running things internally and making sure that, these banks can deal with all these types of risk that they're going to face. What happens next is, let's say, so after these tests, right? So after the supervisory review process, after the stress tests are run, the results of those tests have to be publicly disclosed. So you run these stress tests, right, from the supervisory review process. The results of those tests are then disclosed publicly so that everybody can look and go, okay, this bank looks pretty good. This bank looks pretty good. This one, maybe not so much as some of the others. And the idea here is that more information for the consumer is always going to be better. The consumer is always going to be better off given that they have more information. Now, we can talk about all three pillars in great detail, but the first one is super interesting. Right, and this is like where the assessment of credit risk is established, and this is where my banking career has been mostly up until a few months ago. And the idea is they want to be able to assess the risks that they face and then figure out how the bank can respond to a series of adverse events. Now, the models that we talked about in the last lecture would fall under this. So there's like the probability default models, there's the exposure at default, loss given default, expected losses, all that stuff, right? This is going to help banks understand what's known as a current expected credit loss, or CECL. And once this stuff is taken care of, right, once we sort of understand, actually, you know what, let's not worry about that just yet. Because maybe you want to know what this has to do with banking crises. Well, I'm going to be getting into this in like a week, so a little bit of foreshadowing here. But banks, just like any other corporation, will have a C-suite of executives, so like CEO, CFO, COO, all that stuff, right? Well, one of these is specifically tasked with overseeing risk, and this guy is the chief risk officer. This person is the chief risk officer. And they essentially oversee all of the operations regarding like risk management, risk mitigation, risk prevention, all that stuff that's conducted by the bank. And this is not a position that I think I would ever want. And I'm not really sure it's a position. I don't understand how anybody would want this position. Now, departments under the chief risk officer are the ones that are going to be responsible for assessing risks that the banks face and how they're going to avoid any excess and unnecessary exposures to risk. And these are the guys that are going to be running the stress tests. And stress testing and CCAR are very important components of risk management for any bank. So what is stress testing? Well, this is kind of where we start to get into like that second pillar that we were talking about. And the stress testing stuff is set by the Dodd-Frank Wall Street Reform and Consumer Protection Act. These stress tests are intended to make sure that banks can absorb losses. They can weather the storm that I was talking about during particularly stressful conditions. And these tests are usually run annually. And once they're run, banks then have to disclose their results to the public. And there are two main components to stress testing. There's a Dodd-Frank Act stress test. And this is stress testing whether banks can absorb losses from bad scenarios. And then there's CCAR, Comprehensive Capital Analysis and Review. This is a set of capital action plans that will be based on different hypothetical scenarios. So these two guys are just slightly different. And the requirements for these depend on the various sizes of the banks as set by asset holdings, right? How big is the bank? Now, CCAR was initially required for banks with $50 billion in assets. But that changed in 2019. That exempted certain banks between $100 and $250 billion in assets. And that's one of the things, if you've heard about the collapse of Silicon Valley Bank, people going, oh, we should have regulated the banks more. Well, this is what they're alluding to. However, there are some arguments that had Silicon Valley Bank still been subject to CCAR requirements, they may not have actually shown any systemic issues. So good job that regulation would have fixed anything here. It very well may not have. Anyways, we can get into that next week. So for anybody that wants to comment and be angry, oh, well, whatever, just wait. Just wait a little while to hear me out. So what happens during CCAR? Well, right before Valentine's Day every year, so when you're like, I'm going to take my girlfriend out, or I'm going to take my wife out, or whoever, and we're going to, have a wonderful weekend over Valentine's Day. Then the Federal Reserve goes, ha ha, and they release their scenarios. Well, may as well put your plans on hold for at least a week because you're not doing anything except running all sorts of scenarios through the models that you are in charge of. Now, there are really three sets of scenarios. There's a baseline scenario, there's an adverse scenario, and then a severely adverse scenario. The baseline is like basically in the event nothing changes, nothing good, nothing bad, just where are you on your day-to-day absent any bad shit from happening. Now, adverse and severely adverse are basically like you're going from bad to worse. The adverse scenarios would be like, let's say you go into a recession for a little while. Not a big deal. Things are worse than the baseline, but they're not like the worst thing in the world. Severely adverse is like, what happens if there's another financial crisis, right? What happens if basically everyone just completely S's the bed? Now, what do these scenarios do? How do we make use of these scenarios? Well, what we do is we've got all sorts of models already in place that use conditional forecasting methods where you can feed a predetermined scenario for one variable, or even sometimes a set of variables, into the model to see how other variables will respond. So what does that mean? Well, let me show you. Let's say you've got a model of GDP, which is also a function of inflation, an interest rate, and the money supply. Well, if you look at equation 2, right, you're saying GDP is a function of inflation, interest, and the money supply plus some error. Well, if you had an unconditional forecast, right, what you would be doing is you would already have estimates for what the alpha 1, alpha 2, alpha 3 are. And then you just basically go like, all right, well, inflation was this today, interest rates were whatever they are today, money supply, whatever it is today, output is whatever it was today. And then you basically just go, okay, we'll push it one period forward, right? So instead of going from pi t, you go like, pi t plus 1. And you're basically using the model to push everything forward one period, but there's no condition, there's no control over what you're doing. So it's kind of like just shooting blindly into the sky, right? There's no target that you're trying to hit. You're not going like shooting down a particular shooting range. You're just like, whatever, I just feel like shooting whatever the hell I want, just firing your gun off in the air, right? However, a conditional forecast would be like, let's say there's a scenario where the Fed raises rates above a certain threshold, and let's say they're doing that in response to a high inflation environment. Well, the Fed is going to give you a data set that is to be fed into a model like this, where you have interest rates increasing, where you also start with inflation being relatively high, and then it begins to drop over some, predetermined period of time. And you're going to want to see how GDP is going to respond, right? So what's happening is you get these macro indicators, and you're trying to control for those macro indicators to see how, say, for example, GDP is going to respond. Now, the bank itself, right, GDP, like the bank's operations will obviously feed into GDP, right? But the bank is not like GDP, right? The bank's more concerned about other things. They're concerned about other things that stem from fluctuations in GDP. So equation 2 here, this isn't the end-all be-all for the bank, right? This is really just like step 1. Because what happens is you get that yt, or you get the path of y over time that is then fed into other models that have macro indicators such as probability of default models, right? Because you'd have a lot of loan level data, but you'll also have some kind of a macro indicator there. And that macro indicator is really what's going to be driving a lot of the conditions surrounding how probabilities of default will be changing over time. So you get like these more micro models with macro indicators to sort of give a predefined or preconditioned path over time, and you want to see how everything is going to be responding. So you'll take the outputs given the inputs from the Fed scenarios, and you'll put those into these micro models. And then the idea is, if the economy goes into a recession from increased interest rates, will the bank be able to absorb any potential losses from those additional defaults that are likely to come? They take that, and then that gets published, right? Those results, these are essentially the end results of the stress test that are then published for all the world to see. And that way, the public can assess the adequacy of these banks so that nobody's really caught off guard. Now, that's going to wrap up this lecture. And to conclude, banks have to maintain capital requirements, and a lot of these are determined by Basel II. Now, according to Basel II and just the financial regulators in general, banks have to submit to stress tests on an annual basis and then publish their results, which makes sure that banks are liquid, that they're solvent, and that they can maintain confidence with the public so that people want to continue to use the banking system. And the Federal Reserve provides guidelines for a lot of this in the United States, right? So they do a lot of the regulation stuff in the U.S. Now, next time we're going to be talking about the tiers of regulatory capital set by Basel II, and that's actually kind of a lie. I think we're really just going to be getting into banking crises. So scratch that last little bullet point there. I think it's time to get into bank runs because that's more interesting. I know I'm kind of flying by the seat of my pants here, but bank runs, that's where this stuff gets really cool. So thank you for watching. Thanks for tuning in, and I will be seeing you the next time I see you.